they can do. They butt up against their exposure limits, and you're not getting anywhere near the trillions of dollars, the figures that we're talking about here at COP29, to achieve the adaptation and mitigation. And so that's where blended finance comes in. That's where you need private capital to come in. What is blended finance? It's the mobilization of the private sector alongside the official money, the public sector money, whether that's government money, whether it's the development finance institutions that are coming in. And it's about managing that risk. The Assistant Minister spoke about de-risking the projects, making sure that you create some kind of credit enhancement that reduces the risk premium that is being charged by the private sector to come in with their capital. Some of the examples of that are the political risk insurance that's provided, or full or partial guarantees, or first loss capital that comes in. All of this is about reducing the risk of the transaction. We have some specialist entities like Garantco, or the Emerging Africa and Asian Infrastructure Fund, which Department of Foreign Affairs and Trade is a shareholder in, that are able to catalyse that investment. And sometimes you have securitizations where you take a pool of these transactions, you wrap them up in a way that you can have different tranches where investors can come in at different levels where their risk appetite is appropriately addressed. Some MDBs are doing that in that space as well, risk transfer securitizations. But the main thing about it is how it, perhaps for this sector, about how you get to those hard to reach areas like small and medium size enterprises. A lot of these MDBs offer portfolio guarantees to financial institutions, so that they can offer products that are targeted to SMEs, whether it's in the development finance space, whether it's in the climate financing space, but allows them to take that additional level of risk that they otherwise wouldn't have taken, because they've got the guarantee backing them, and they are able to provide those products. And when MDBs are involved, you also see not only that de-risking, the reducing of the risk, but you also see some of the positive externalities, like the guidance and policy advice in how to reform some of the business operations in a way that not only facilitates that individual transaction, but actually paves the way for a better environment for future transactions to flourish in the country.
Thanks very much, Matt. You made me think when you were talking about SMEs that often I'm guilty of thinking it's a small part of the economy, but I remember hearing in Southeast Asia, SMEs represent, it's something like 70% of GDP and 80% of the workforce. So I think it might be hard to get right down to target them, but the power and the impact you can have when you do is pretty significant. So thank you. All right, I'll move to you, Jessica, for the next question. We've also heard a little bit about CSEF. For some in the room, there is indeed a screen behind me, which if you haven't, there's just some headline points on what we call CSEF and CSEF 2, its second funding round. Can you tell us, Jessica, from your own perspectives, a little bit more about CSEF 2 and how it's being used, how it's using blended finance to attract additional investment into that fund?
Firstly, I would like to send my heartfelt thanks to ADI for your amazing support and having me here today. This is my first COP, and I'm very honored to be in this panel with the senior people like this. So I'm Jessica, Country Manager, Clime Capital Management from Hanoi, Vietnam. We manage Southeast Asia Clean Energy Transition Facility, CSEF, the first blended equity investment fund established in Southeast Asia, supported by leading international foundation and private sector investor to direct early-stage, high-risk investment capital into innovative, high-impact clean energy projects in critical Southeast Asia market. We invest in renewable energy generation, energy efficiency, energy storage, smart grid, demand-side management, and electric mobility. We have 3 key threshold requirements, with the priority is climate impact, additionality, and commercial viability. At CSEP, we understand that the region it needs $100 billion annually to advance the green transition. So CSEP use blended finance to attract additional capital by leveraging junior equity, thanks to our honor partner like ADI. This strategy positions CSEP at the forefront of exploring innovative financing solutions, direct early stage investment and development support to the companies that can lead the low carbon transition in Southeast Asia. We believe that we support and contribute to create public good that benefit a diverse range of investors interested in the region. As a people on the ground, together with my team in the headquarters in Singapore and country manager in Indonesia, Philippines, we employ a comprehensive process to identify, monitor, screen, and accelerate hundreds of emerging small and medium climate tech startups across Southeast Asia. We select the most mature and premium companies to advance in our due diligence process for potential inclusion in CSEP, now CSEP 2, and to target the big impact for the transition. Yeah, is my answer.
Wonderful. Thanks, Jessica. For those who aren't aware, Jessica mentioned ADI a couple of times. So that stands for Australian Development Investments. But just to give you my sort of perspective on it, so when the Australian government a few years ago decided to just experiment with blended finance, it made a $40 million facility to try some things out. And it was under the premise of being able to leverage $3 from the private sector for every $1 that the Australian government invested. And it was pretty hard fought to get the government over the line to make that investment, because for those who have worked in the public service or the civil service before, we're pretty typically risk averse, and it's those sort of stories where government investments have gone into something and lost a whole lot of money that usually get a political headline. And so it was hard for government and ministers to agree to, ultimately Australian government taxpayer funds being used to take first loss or provide a guarantee for an investment by someone else in an untested project or untested market. But that $40 million pilot phase of what is now ADI delivered a return. We hoped it would deliver a return of 3 for 1, private for public funding leverage, and it ended up delivering close to 5 to 1. And so that gave our government enough confidence about 18 months ago to turn that pilot into a much broader scale permanent financing facility, and they put 250 million Australian dollars into what is now called ADI, Australian Development Investments. So some of the projects you're hearing about, or the funds that we're talking about today, are funded by ADI, which is a fund of funds. All right, thank you. Geoffrey, next one's for you. We've heard, or I'll have a slide, yep, we do, behind us, about TAF2. Lots of acronyms in this space, like all things climate. And yes, additional background up there. Can you tell us a bit more about TAF2, how it mitigates carbon emissions and supports adaptation? And then secondly, how does New Forests integrate carbon markets into sustainable forestry projects?
Thank you, Kristin, for the opportunity to speak here. And I'm going to drop another couple of acronyms. So I'd like to thank ACFP, Australian Climate Finance Partnership. They are one of the investors in our fund, so kudos to DFAT and the Australian government as well, and one of our early supporters. Our blended finance journey started in 2019, 2020, and it was born out of the realisation of trying to mobilise private and public capital into the space so that we could scale and affect not just climate change mitigation, but biodiversity conservation, preservation, and even livelihoods and life on the land. And so blended finance, as correctly stated, is to target certain pools of capital that require different outcomes that may not necessarily be financial outcomes. They could be impact outcomes. And so when we're up to the Tropical Asia Forest Fund 2, which is what it stands for. And our first fund that we raised in Asia in 2012, Tropical Asia Forest Fund 1, Imaginative, But it was adhering to the certification standards, so Foreign Stewardship Council, IFC performance standards. So it was more of a do no harm approach. And so as we wanted to structure and be true to our vision at New Forest for TAF2, we wanted to do a structure that allows us to do more good. Impact with intentionality, so we could actively target that as part of the investment case. And so we came up with a concessional finance model. It's not a first loss. It's two classes of shares, and the impact investors get their money back and some return and share in the upside. But in order to catalyse private sector capital, there is a flow between a certain return range into the commercial space. And so what that achieves is there is a perception out there that impact investing is bad for business. And we are here to show that that is not bad for business. In fact, they are complementary and they are actually good for business. And when we then look at this intentionality, we are now able to generate positive impact around climate change mitigation, biodiversity and livelihoods. And being able to integrate that at the outset of the investment process through our mixed landscape approach, which includes elements of conservation, carbon, community involvement, biodiversity, industrial tree plantations, processing, to maximise the use of that same piece of land to do more with, has enabled us to then generate these climate benefits and biodiversity benefits and adaptation and resilience. And integrating them at the beginning of the investment cycle allows the best value for money or the biggest bang for your buck, because there is a theory of change in what we're trying to achieve. And I think that's one of the things and one of the innovations that we've been able to bring to the market as a manager.
I'm going to ask a unprepared follow-up question, if that's all right, Geoffrey, because I'm really conscious that there has been a focus internationally on climate finance for a little while and monetising emissions reductions or climate benefits. But more recently, we've also seen a similar approach through biodiversity and nature capital markets. So a lot of what you were speaking about, I could almost sort of see in those two lenses. I'm just interested in your perspectives on challenges or opportunities about sort of bringing climate finance markets and nature finance markets together.
Yeah, so I mean, I think that's a very important point, and the Assistant Minister also alluded to that fact. We are not just talking about climate and carbon. There was an analogy drawn, so to value nature just for carbon is like valuing a computer for the silicon that's in it. It's not the user experience. And I think COP, when you talk about sustainability, and I said this at the last panel, when we talk about nature, even though this is a climate conference, you see all the pictures outside, they're of nature. And I think it's important to note that climate is the first and the only enabler, aside from the timber that we grow as a sustainable product, that climate is the only first stage in that monetization. So what we do as part of that mixed landscape approach is to build in that optionality, because that appeals to investors. And so we have biodiversity baselines, we do the reporting, we do climate projects in and amongst our plantations and standalone. And so that future is what they call in financial markets alpha. And so above a risk-adjusted return, which can only then draw in more capital into the space. So ultimately, it's a scale game. And unless we scale into the trillions, we're not going to make a meaningful contribution to climate change mitigation.
And what are the challenges?
There's lots of challenges. Look, I think there's a compliance space when you're talking about climate, which we operate in. So North America, ARB 32, we operate in the ACU ERF mechanism and the New Zealand ETS. The emerging markets for us is Southeast Asia, Sub-Saharan Africa, and so these are the voluntary spaces. And I think part of it is that, you don't have things, you need climate and carbon to act more like financial markets. So we know the mechanism exists, but we need to have price curves, we need to be able to underwrite, we need to be able to manage that risk, we have market makers, hedging instruments and what have you. And we're there. We have, all this is in place. And it's just a matter of the last little push. And I do believe that push has to come from government. And governments need to regulate. And so if you look at whether it's an ETS mechanism that we have in the safeguards in Australia, or whether it's Singapore introducing a carbon tax, because you can't leave it to the private sector to price the negative externalities around social and environmental, because you know how they're going to price that. Now, governments may or may not be able to do that any better, but they're in a better position in terms of neutrality to be able to figure out what this costs our environment and our country. And then by underpinning that price, now we can start to underwrite risk. And that's what we do. And once we know what that risk is, we can manage it and drive more capital into the space, not just for climate, but for nature.
Thank you. So from risk ratings to credit ratings, back to you, Matt. Moody's ratings can attract significant capital to climate investment funds. How is Moody's working with the blended finance community to rate transactions that drive climate outcomes?
Yeah, I think I'd phrase the response in 4 ways. The first way is on the actual transactions themselves. Moody's has rated a number of these transactions where we see credit enhancements, changing the risk profile, achieving a higher rating. That encourages a lower cost of capital, the investors coming in. The problem that we've seen with a lot of those is that they haven't been repeat business, so to speak. The projects haven't been replicated. The securitization structures take a long time to get your head around. The due diligence that is done on some of the guarantees means that they take a long time to happen. You do need pilots, I agree with that, and you have to prove concept. But once you have a concept that works, each time you reinvent the wheel, that slows it down and makes it harder, not just for credit rating agencies rating the instruments, but also for investors to get their head around what they're putting their money in. The second thing, we're assigning ratings to some of those specialist institutions that I spoke about, Garantco or the Emerging Africa and Asia Infrastructure Fund. There's also the Africa Local Currency Bond Fund. There's a number of those development finance institutions that operate in that space, but there's also those that are operating in the climate space. More recently, we assigned an A3 rating to the Global Climate Partnership Fund, and also a AA1, a very high rating, to the CIF capital markets mechanism. That's the financing vehicle for the Clean Technology Fund, which the Australian government invested in. Achieving a higher rating allows them to borrow at a lower cost, allows them to pass on that lower cost capital to the ultimate obligor, the investor that is, the transaction sponsor that is investing in the project. The third thing that we're doing, we offer what we call a second-party opinion and also a net zero assessment. That's not credit ratings per se, but it's part of that communication strategy. How does the project get their message across to the ultimate investors? What is the alignment with the NDCs? To what extent does the net zero targets that they have, the ambitions, how implementable are they? What is the governance strategy around it? So they're not credit ratings, but it is offering investors that additional level of understanding, leveraging our knowledge of the carbon transition risk that's present, how investors can see that residing in their various portfolios where they can deploy the capital. Perhaps the final thing that we're doing, and that's the reason why I'm here today, we're engaging in the debate. It's very easy for credit ratings to be seen as the problem. That's what's holding back the investment. Well, no, the credit ratings is just an assessment of getting your money back on time and in full. And if you can provide some credit enhancement, then obviously the assessment is better. But we're also sharing our proprietary data, which shows a lot of these infrastructure transactions actually have lower default rates, have higher recovery rates. The MDBs are sharing their GEMS data that shows exactly the same thing. And if investors are aware of the lower default rates, the higher recovery rates, they're more able to price, presumably at a lower price, a lower risk premium, their willingness to come in. And that's where not only are we providing that to investors, we're also providing it to regulators as well, because regulators are making investors set aside certain capital to cover the risks that are involved. Well, if the risks are actually lower, then it's for regulators to acknowledge that and allow investors to leverage up and multiply, and that's when you get more of those transactions that investors are willing to get in. So that's where I see Moody's role being a constructive element of that debate.
Can I ask, I'm trying to work out in my head, and I don't know if there is an answer, but does greater transparency around risk ratings move towards lower risk ratings over time? Sort of what does it end up doing to where investors lean? Does it sort of pull you in one direction, put more money there, which by virtue of that perpetuates overall lower risk ratings?
Yeah, I think it's the classic case that a lot of those that are willing to go and get a rating, they also have to fess up to warts and all. What are the bads as well as the good? And they worry that by elaborating on the bad, and in this case, what is the carbon transition exposure? What is the climate risk? What does the future look like? How exposed am I? By admitting to that, they think this is going to lead to a lower rating. But actually, it's the opposite of that. By being open and transparent, by demonstrating to the investor community that warts and all that's on the table, you know and understand what you're getting yourself into, and that you can accurately price what your exposure is, that's where you see the tangible benefits. And ultimately, this is all about making the ecosystem work better. And so credit ratings are only one part of that. Issuer transparency is another part of that. But you need that in order for governments reforming the operating environment as part of it as well. You need all of that working together for investors to come in.
Okay, thank you. All right, Jessica, back to you. At an industry level, what sectors are showing promise in Southeast Asia? I know you mentioned a few before, but we'll get you to go into a bit more detail. And how does CSEF promote gender equality through its climate investments?
Yeah. With more than 2 decades experience in the market, in the region, I must say that it's high growth, high risk, and unexpected in terms of policy in some areas. However, clean energy and green transportation are showing promise, and there's opportunity to growth and the investment can come there. Southeast Asian country target to achieve 23% of renewable energy of the total energy primary capacity by 2025. The government is working hard to ensure energy security to cope with the growing energy demand of 8 to 14% annually. So that's why government provides supporting and clearing policy framework to drive renewable energy investment. And there will be opportunity for investors to invest in distributed renewable energy, especially rooftop solar, because it becomes more and more affordable, accessible, scalable across scale. And with the renewable energy adoption, it's critical to invest in energy storage to increase the reliability of the grid and also the efficiency of the power supply system. Related to utility renewable energy scale, why many investors looking at that big investment, but our recommendation is to be selective, invest in the stable regulatory environment is a suit. Another sector to target is energy efficiency. Many Southeast Asia countries set their own energy efficiency target. For example, Vietnam, they target 2% annually, and the government aims to increase energy intensity from 20% by 2020 to 30% by 2025 across Southeast Asia. With the availability of the energy efficiency technology, I think government and businesses can seek the solution to reduce energy consumption, reduce carbon footprint, and achieve their short-term gains and long-term sustainability goals. The third sector is electric mobility. Bolstered by air pollution, extreme weather, Southeast Asia now try to increase the EV adoption. So the investment in EV infrastructure it will be a priority for the governments there in the roadmap from now to 2030. So investors can invest in EV technology, the charging network, and its ecosystem. CSEP did more than almost 20 investment until this year. So you can discuss with us after this panel if you're interested in that sector. Related to your question about how CSEP promote gender equality, our core objective is to maximize every dollar of committed investment. We also ensure gender lens and inclusive climate action in all stages of our investment process. I'm deeply aware of the significant gender disparity in the energy sector in Southeast Asia. You know, women founder, CEO represent less than 5% of the climate tech startup, and women account for less than 30% of the workforce, predominantly in the position of supporting office, admin, human resource. The main disparity is driven by few barriers such as lack of required skill, qualification, training, limited access to professional network and financial resources, lack of supporting system to ensure better work-life balance. To address that, Clime Capital has integrated gender perspective into our investment strategy. Together with my team, I work with our investee company and also the company in our radar, and we broaden the ecosystem to shift the mindset around vendor smart investment. We have implement the capacity building support through the peer learning network. I myself work like the help desk for many startup companies as a peer-to-peer mentor, trainer, advisors, and we connect the small and medium company to the co-investment platform. Thank a lot to our philanthropy, private, public, partner, local and international. We engage women in the climate leader network and also link them to the Sea-Wind Climate Help Desk system so that women are empowered by other women and they receive the tools, the network and the opportunity to thrive. So I think that by doing so, we can not only accelerate the low carbon transition at low cost, low conflicts and just future for everyone.
No, thank you, and thank you for the work that you're doing around mentoring other women in this space. I think it's really commendable. You made me think that of a sort of serendipitous positive outcome that wasn't planned. I observed a little while ago in the Australian government. So when our current government came in about 2.5 years ago, they brought a requirement for all major budget measures going through our cabinet process to have a gender impact assessment. And really that was about avoiding unintended negative impacts on women and girls through budget measures, through major funding programs. And there was a really large energy efficiency package that came through, which was, I think, 1.3 billion Australian dollars on energy efficiency support for social housing in Australia. And they did the gender impact assessment on, so it came through as a climate measure. That's what it was. But they did the gender impact assessment because all our new major budget proposals have to go through that. And it just got all these gold star rankings against all the gender impact because it was providing much more comfortable living environments in social housing and significantly reducing household energy bills. And the metrics for the number of women that either are in social housing or spend, you know, if it's a family in social housing, it's often the woman spending most of her time in that home. So it had this disproportionately large positive benefit for women through an energy efficiency measure. And that wasn't part of the planning, but it made it even more compelling for our government to approve. So I think those connections there can be really important. All right, Geoffrey, last question for you before then we throw open for questions from the audience. How do you work with the local community to promote biodiversity and ensure that the benefits of forestry assets are shared, including with Indigenous groups?
Thank you, Kristin. And, you know, when I said earlier about targeting that shared value and livelihoods, that's certainly something that we look at. And that whole integration into, that early integration into our investment process and then applying the theory of change to get to a certain outcome. So when we look at, once we're looking at potential assets, we're doing environmental and social impacts, we're taking economic and land use participatory mapping baselines, we're doing biodiversity baselines, and we're coming up with a gap analysis and an environmental and social action plan. So there's lots of acronyms, but basically it means we want to affect that whole positive impact outcomes in all our assets. And I might give you some examples, but that impact assessment and action plan will invariably target the most vulnerable communities first, and with them have things like outgrow schemes and programs where they grow trees on their land, we provide them with the best genetic stock that we can find, and then they get to monetize it after a certain number of years, and we have the option to buy it, but if they can find a better price outside, then it's all good for them. So I think that's an important point. They own those trees. And so that whole principle around shared value, I mean, I think the best way to describe it is to just give you some examples of what we've been doing. So we have continuous FPIC, and for those who don't know what FPIC is, it's free, prior and informed consent. So a fully informed Indigenous person or community needs to know exactly what we're doing, and we need to work with them to get their consent with full information before we even start. And so we do continuous FPIC. If we've got harvesting activities or planting activities and they don't want us to use so much pesticides or what have you, then we'll work with them. And we have community teams embedded in all our assets, and they constantly go out and meet communities. And in these meetings, if 50% of the meeting is not women, we'll come back another day. Because invariably, and I know women make better financial decisions, I know that for a fact, but it is what it is. And so that whole empowerment of women, in Africa we've signed up to 2X, we're the first manager to put fees at risk if we don't achieve certain environmental and gender equality targets. Another great example is the youth inclusion program. So us in Australia and other places don't look at a 16-year-old working at in a cafe as something that's alarming. However, because of the principles, we can't do that in other countries. But we know that the youth, and this is the local knowledge, we know that the youth earn money for their families, so they need to go out to work. So we have youth inclusion programs whereby we hire youth, we do not put them in high-risk activities, so typically in the nurseries, but they only work for us before and after school, and they have to go to school to be able to take advantage of that program. So they still get the livelihood, and they get that capacity building, which is what we do. We try and localise management. They provide for their families, but they still get their education. This extends to mentorship programs and a whole bunch of other things. And 1 becomes 2, 2 becomes 4, 4 becomes 8, and you have that multiplier effect. And I think it has to start at the ground level, but doing these sort of things with that intentionality and integration at the outset is so much more effective than trying to bolt it on 5 years down the track. And what are we going to do now? And so I think that's part of what we try and achieve in our assets.
Thank you. And even though you didn't mention it, it made me think that because I often hear stories about the impacts of climate on gender, is that in poorer communities, if a family needs to make a choice about earning income or sending the kids to school, it's the girls they take out of school to earn the extra income for the family. And so your rules about, well, we're providing the income, but on the basis that you're still going to school, I think, whether it's intended or not, possibly also has a gender benefit. So well done. All right, we do probably have maybe around 8 minutes or so for questions from the audience. So please, I can keep asking questions, but I'm just conscious that if you came along here, you've probably got a real interest and stronger knowledge than me in these areas. So your opportunity. Have we got a mic, Ollie, or should I hand this over? Thank you. The gentleman, third or fourth row.
Yeah, thank you. Maybe specifically to Geoffrey, but whoever, or to everyone who invests in nature-based solutions. I was just wondering, how do you account for climate change-induced risks to your revenues, to your business model, water-related risks, and so on and so forth? Does that imply that you involve insurers in the blended finance scheme, or how does that reflect in your blended finance schemes?
Yeah, and again, when we consider the effects of climate change, Australia's probably a great example, or California in our assets there. You've got fire risk. Some parts of that are uninsurable. But we do have, luckily enough, insurance companies as our investors. And so what we do is we build that into the investment case. So we look at expected losses, 50 years, 40 years, and build that in so we know that there is going to be an event and it's priced in. So we have climate models, we understand that where the data is available. Where the data is not available, again, that's partly where blended finance kicks in. You have different types of structures with first loss tranches and what have you. But it's a conscious decision to ensure that in the investment process, when we're pricing that risk, we price it to the best of the knowledge that we have at the time. We may not always get it right, but the consideration of that risk has to be at the forefront.
Thank you very much. Other questions? Just one up here. Thanks, Solly.
Hi, thanks. That's really fascinating. Nikki Hutley, I'm an independent economist. Just wondering, none of you have actually mentioned specific return on investment and how that's, especially with blended finance, the expectation of government returns over the private sector returns, especially with biodiversity. How do you actually quantify those returns? I mean, from a ratings agency perspective as well, you know, how does that go into what you do? So from all of you really, how do you quantify those returns and how important is it, particularly in markets where we're not pricing the externalities with a carbon price? You don't have that stick.
Thanks, Nikki. I'll just check if Jessica or Matt want to go first. Go, Geoffrey.
So as an investor in the space, I mean, I think if you look at New Forest since inception, we're probably top decile. We're doing 14 to 16 in Australian dollar terms with an 8% yield since 2010. But then if you break out some of the emerging markets returns, then it starts to get a little bit more interesting. And I do think that, and I may reframe that argument, especially in the context of blended finance, that returns to people are not necessarily always economic. And so different people rate returns in different ways. So the idea is to generate the economic return because we need to crowd in the big pools of pension capital. But we have foundations that want us to do more climate change mitigation. So they get their money back with an inflation link and upside. But there are climate targets or carbon targets or biodiversity targets that we sign up for. And again, in Africa, we've done some of that and put our fees at risk because of that. And so we do target infrastructure-like returns. And at this point in time, for most of our assets, we don't underwrite aggressively carbon or biodiversity. The bulk of the return still comes from our tree and timber production, which is a much more developed market. And so on a risk-adjusted basis, if the climate markets start to move or biodiversity markets start to come in, then it's boomtown Charlie for our investors because that's pure alpha on top of all of that.
Thanks, Geoffrey. Other panellists?
Maybe very quickly, it's probably not for a credit rating agency to comment on return on investment per se, because a credit rating is the likelihood of being paid back your money on time and in full. It's the investor that demands the return on investment, but that's part of the risk premium that they're factoring in, and to the extent to which we're able to foresee into the future, the horizon of a credit rating isn't the next 2 to 3 years, it's whatever we can factor into the future with a reasonable degree of confidence or some kind of scenario analysis around it. And certainly from a climate perspective, we've done a lot of research on what are the future costs and what are the costs avoided from upfront climate financing action now on adaptation and mitigation. Certainly the debt incurred for that investment has a fiscal implication here and now, but the benefits that accrue or the costs that are avoided, that's tangible. That's something that we need to be taking into account. Whether it happens in 10 years, 20 years, 50 years, we're grappling with that as much as anyone else is, but there's certainly no denying that that is a cost that needs to be taken into account in that consideration of whether you're going to get your money back on time and in full.
I've got a curveball. Sorry, no, I'll let you ask the question actually. Microphone coming. So.
Yeah, sorry, I missed most of the presentation, so I hope this isn't a redundant question, but I noticed you said concessional finance and you also mentioned first loss stuff? Is there other concessional finance things? And also, I don't know whether you measure the carbon benefit in there. So do you actually get a cost of carbon number out of your investments? Or just those two questions.
Thank you. Geoffrey, after you.
Yeah, so we do, and so to give you an example of our Tropical Asia Forest Fund 2, 90% of those returns will come from timber and timber production, 10% will come from carbon, and that's what we're comfortable to underwrite, and our investors are. Now, I think what you're starting to find is as the carbon markets continue to evolve, and these are the voluntary market carbon markets, as they continue to evolve, we'll get more and more comfortable about underwriting risk in those markets once the market develops. In Australia, it's a completely different thing. They have a compliance mechanism under the safeguards, they have methodologies, and they have price curves, Reputex. And so you can see the forward pricing. Now, how you think about that forward pricing obviously is up to how we think that whether we can generate that carbon, but there's much more certainty in terms of what we think we can underwrite. And so what you're seeing now is in our new funds, as that market continues to develop and the demand starts to ramp up, we become more and more comfortable with managing that risk. And when you can manage risk and diversify some of that away, then you don't have to price up so much of a premium. And I think as a manager, we think, we can manage that risk better than other people. And so we're best placed to price that risk in the most efficient way. And that's how we do our business.
Thank you. Another question up the front.
Hi, Geoffrey. My name is Mark Tilley. I'm from Carbon Pulse. I was just curious what you're talking to your shareholders about regarding political risk in Australia's compliance scheme, given that we don't really have any certainty at this stage whether the opposition is going to continue the scheme in its current form or not. And obviously there's a federal election coming fairly soon.
I think that train has left the station. And so if you saw, and to compare it to a neighbour a long way away, if you saw under Trump 1, corporates and states, they went their own way. And I think the momentum behind the markets now and the underlying consumer who demands certain things from their products and corporates is there. And so the momentum now in the markets, I think, is far beyond any sort of political, whichever party it is, and what have you. So we are hopeful under Trump too, and I'm not trying to draw an analogy with Australia, but I do think that train has left. So, what we're seeing now with corporates are starting to wanting to invest in these markets. They're a big potential funder of these projects now. Why? Because they want to invest in the upstream, they want to control the integrity and quality of those projects, and they want to invest with reputable managers. And with that and the reporting and disclosure requirements that are coming, and you see this in Europe already, TNFD, SFDR, EU taxonomy, with those, when they're forced to disclose more about the risks on their balance sheet, people can see. And they make then informed decisions about, it's almost like an FPIC approach. They make informed decisions about the consumption, the products they want to use, the institutions they want to bank with, the investment managers they want to give their super to. So I'm politically agnostic, and I'm not dodging the question, but we see that all the time. Political risk, again, you think Laos is massively political risk. They're right at the bottom of the table. That's the best place we've ever done business. And thank you to the Australian government for helping us in the High Com, to helping us to navigate that. But that's the best place. That's the least risky of our investments.
Maybe one thing to add to that, the market has an amazing way of imposing discipline. Sometimes get asked the question, it's not a credit rating question, but ask the question, what's the difference between a green premium or a brown penalty? And do the Australian government or Australian corporates get charged a brown penalty? And it's factually correct that the market is looking and saying, well, maybe it reflects the market, so to speak, and the way that it's evolving, because maybe in past years, the desire for having prove your green credentials, you would pay a green premium, offer a lower a price to participate in the issuance, whereas now the expectation is that all corporates, all governments have a clearly articulated, well-defined, implementable good governance around a net zero strategy. And if they don't, then the investors say, well, I'm going to charge you a penalty for that, because if you want me to buy your your paper that you're issuing relative to someone else that does have a good, compelling argument behind them that is going to deliver on the climate strategies that they're promising, well, I'm going to have to charge you a premium, a brown penalty to hold your investment in my portfolio. That's not me as a credit rating agency analyst. That's me talking to the investors and what they're telling us. And when investors are charging a penalty, that increases your cost of financing. And when you're having to pay more for your debt, that's has credit implications, and that's where it's circular. It comes back to, well, if the market is not willing to buy your debt, then chances are you're going to see your credit rating deteriorate, and that's going to get even more costly. And it's the market talking back in that perspective, imposing that discipline on making sure. So in many respects, Australia is beautiful in so much that it doesn't really matter who's in power. They're going to have to subject themselves to the scrutiny of the market.
All right, thank you very much for such an interesting conversation. Do stick around. We've got 3 more minutes of somebody talking at you from a screen, but can I just ask you to thank our excellent panellists, Matt, Jessica and Geoffrey. Thank you very much. You are welcome to sit up here, but it's a little hard to see what's about to play behind us, so feel free to hop in a comfortable position, and I think we're ready to play the video. Thank you.
Hi, I'm Pat Conroy, Australia's Minister for International Development and the Pacific. I'm sorry I cannot be there in person, but grateful for the opportunity to deliver this message. Congratulations to Azerbaijan on this 29th COP. This is an exciting time. The global transition to net zero is reshaping entire industries, from agriculture to transportation, as economies rewire and rethink the way they do business. In Australia, the government is positioning our nation to lead this economic transformation. And internationally, we are committed to Australia being an early, impactful investor in green innovation across the Indo-Pacific. That's why our new international development policy and recent development finance review emphasised expanding our blended finance capabilities. Blended finance is a critical tool that allows us to combine resources and expertise across sectors, unlocking investment and innovation that drive development and climate outcomes. We launched Australian Development Investments, ADI, as Australia's own international impact investment fund. ADI demonstrates that even with modest concessional investments, the Australian government can shape markets and accelerate net zero goals. Earlier this year, ADI made a $4.4 million anchor investment in the Southeast Asian Clean Energy Fund 2, also known as CSEF. This blended finance fund, the first of its kind, focuses on clean energy businesses and projects in Southeast Asia. ADI's initial investment helped CSEF raise over 200 million Australian dollars, with substantial participation from institutional and family office investors. CSEF is now actively investing in projects like Upgrade Energy Philippines, a solar leasing company pioneering commercial and industrial projects in the region. Upgrade Energy is now set to surpass 50 megawatts of total installed solar capacity by year's end. This is the impact of sustainable finance in action, and we're proud to support it. Today, I'm delighted to announce the $126 million climate catalyst window through ADI. This window will fund climate mitigation and adaptation projects across Southeast Asia, South Asia and the Pacific. Like previous ADI investments, it pairs concessional finance with technical support to ensure robust impact measurement, promote gender equality and enhance project bankability. With ADI support, we will help emerging capital markets attract more private investment, whether directly alongside our contributions or later as the impact market matures. Thank you for your commitment to this field. I hope you all have a productive and inspiring COP29.
I'll let him know he got applause, so thank you. We're just going to put up that slide again with the QR code, which is the new website for ADI. I had a look this morning. It's got some great case studies and stories about some of the small investments we've made.